So welcome everyone to the session tonight. My name is Michele Ferrario. I'm the co-founder and CEO of StashAway. Tonight we're talking about the 2024 market outlook, and the speaker for tonight is going to be mostly our Chief Investment Officer Stephanie, who's here with me in Hong Kong tonight. But before I let Stephanie kind of take the center stage and walk us through her thoughts, maybe I thought I'd share a couple of things myself and also explain a couple of logistical details. So first of all, the way we're going to manage the next 60 minutes is that Stephanie will give a presentation with the market outlook, and then we're going to leave time for Q&A at the end. You can use the Q&A function to write any question you might want to ask at any point in time, and we'll do our best to address as many questions as we can at the end. There's also a team of our colleagues who I thank that will try to respond to some of the questions in writing whenever the questions are perhaps about the StashAway platform and its functioning. Last year, 2023, was a year that surprised everyone. And throughout the year, starting in 2022, there was a lot of requests from every investor for better products to manage their cash. And because interest rate went higher and there's been high returns on cash, a lot of people were focusing on doing as much as possible with that portion of their portfolio. And so that's why we listened and we did quite a bit of work on improving and enhancing and innovating the way cash management products are built. So we launched, for instance, Simple Guaranteed in Singapore that gives a guaranteed rate, which is the best in the market and still today is the best in the market at 3.8%. And then across all markets, we have launched a US dollar cash yield, which gives around 5.3% on cash invested in US treasuries. And the reason I mention this is that we will continue to work and improve and innovate our cash management offering. But I want to stress the importance for every investor not to focus exclusively on cash management. Time in the market is extremely difficult, and Stephanie will probably mention later that difficult to have a crystal ball to understand exactly what's going to happen. It's important to understand the risks, it's important to understand the scenarios, but nobody knows exactly what's going to happen in 2024. But that's not a good reason to not invest, to be completely out of the market and lose the opportunity to make your money work for you, especially if you have a longer time frame, if you're building your retirement plan, if you're building your kids' university funds, and therefore you don't really care what's going to happen in 2024. You care what's going to happen in the next decade, and the next decade starts today, and that's when you need to take hold of your money and start working on it. So without further ado, I just want to make sure that everybody looks at the future with thinking about how to do the best with your money, not just being defensive, but also trying to build for the future. And maybe I'll let Stephanie take over and take it from here.
Yeah, thank you, Michele, and good night, everyone. Welcome to our Market Outlook event for 2024. First of all, because this is probably the first time that we meet each one of you in a new year, just wanted to say have a great new year and also all the best in 2024. Wish you all a very, very successful investment journey ahead. And the purpose of tonight is exactly that, to help everybody to have a better journey ahead. So without further ado, let me just start the main presentation. So I guess the title of tonight's presentation outlook is a matter of when, not if. Hopefully, by the end of the presentation, it'll be clear of why we put this as a title. Again, as Michele said, a lot of things are uncertain in terms of macro outlook and investments and things that are happening around us. But the most important thing is that there are a few key things that we know for sure going to happen, which would help us to achieve great results in our investing. And we'll go through those as well. So let me just start by going through the agenda for tonight. We have 1 hour, and I think first of all, we'll start off by looking at a recap of 2023 and also how StashAway portfolios actually have performed. And then we'll follow that by going into our outlook and also some of the regional themes that we like to highlight. Also, in the last section, we'll talk about how do you position yourself in response to all these macro changes that are happening. And of course, we'll leave plenty of time for Q&A. So if at any point of time you have a question, feel free to post it into the chat box, and either myself, McKinsey, or one of our customer experience team members will be able to answer your question. So let's start with a 2023 recap. I think in retrospect, 2023 was actually characterized by a revival or a recovery in equities, and still a kind of a bond market that is still kind of trying to heal its wounds from the retreat that we've seen in 2022. Here is a chart that shows you annual performance of MSCI World Equity Index, which is essentially global stocks, and in red is global bonds. And as you can see, I mean, most of the time, like, returns are actually positive. So, for example, if you look at on average, equities have returned about 9% on an annualized basis in the last 30, 40 years. And for bonds, the annual returns have been about 5%. In 2022, something that's quite extraordinary happened, in the sense that both equities and bonds were actually down double digits, almost 18% for both bonds and equities, which is kind of a one-of-a-kind event that we haven't seen for a long time. Of course, we all know now that it was due to high inflation. In 2023, equities actually recover a lot faster than bonds. So, I mean, bonds are still in a drawdown after the peak in 2021, but equities have actually made back a lot of the losses. And I mean, seeing that those numbers doesn't not represent the full picture, because actually, I'm sure a lot of us were in the market last year. It wasn't an easy ride. And just as a quick recap, what happened last year, here is a chart for stocks and bonds. The darker blue line is stocks and the lighter blue line is bonds. As we all probably remember, in the first quarter, we had a kind of a Silicon Valley Bank crisis, and that almost spread it out to a bigger crisis in the US banking industry. Both bonds and equities actually suffered. Bonds actually recovered faster, right? Because bonds actually shows outperformance during a economic downturn. And back then, most of the Wall Street forecasters and also market participants were actually expecting a recession to follow, and that's why bonds actually rallied. However, afterwards, there was a big boom in AI. Of course, the U.S. government also pumped a lot of liquidity into the system, and these liquidity actually went to the hottest story in town, which is AI, which benefited a lot of the big cap tech stocks that drove equities much higher. During the summer, we had the worries that basically the Fed is not done with interest rate hikes, and interest rates actually rose to almost 5%. Also, there was worry about a lot of issuance from the US government, and equities actually followed suit and also corrected. And boom, at the end of the fourth quarter, actually, the equities recover a lot, and also bonds recover as well, given the market is cheering on slower inflation. So at the end of the year, equities were up almost 23%, and bonds were up a little bit above 5%. During this year of uncertainty and volatility, StashAway portfolios actually performed quite well in an absolute basis. And on average, StashAway portfolios returned 12%. Of course, for the high-risk portfolios, the return was higher. And for lower-risk portfolios, the returns were relatively lower. But all in all our portfolios actually returned positive in the year. And I guess that is a reversal from what has happened in 2022. So I guess one of the key features of StashAway portfolios is that we try to maintain a constant risk throughout different economic regimes, and we do this by re-optimizing and optimizing our portfolios according to the asset classes sensitivity to different regimes. And the goal is to keep our investors invested over the long term. And one of the ways to do this is by keeping drawdowns actually in a controllable range. And this is a demonstration of how StashAway portfolios have performed on average compared to our benchmark average, starting from Jan 2022, when we first enter into this more difficult kind of market period. Now, as you can see, the StashAway portfolios on average actually had lower drawdowns than the benchmarks during this period, and that resulted in actually bigger outperformance throughout the whole period versus benchmark averages. So I guess the story of 2023 is that a lot of things have happened, but actually people were still kind of confused about what's causing the great kind of reversal of equities. And also, I think one of the things that were most well talked about is whether or not a recession was coming, and at the end of the day, the recession didn't come. And I mean, here's an image of a confused investor. I actually use AI to help to generate these images. So this prompt that I use here is a cartoon image of a confused investor scratching his head, slightly shocked, and perhaps I mean that represents some of our sentiment for this year. And as I said, right, the most anticipated recession actually never officially came. And here is a chart that shows you the GDP growth forecast for 2023, which sort of bottomed in early 2023 and started to get revised upwards. So throughout the course of the year, analysts have been actually revising up their GDP growth forecast. So a recession is officially defined as 2 negative quarters of GDP growth that actually never come to fruition. However, if you look kind of a bit more under the hood, there is a kind of a deeper story to just what the headline would suggest. And here is a chart on the left-hand side that shows you the global PMI index. For investors who have been with us for quite some time, you would know that we actually follow the PMI quite closely because it gives us very, very timely insights into what's happening to the data and the markets and economy, because GDP actually typically only comes out on a lag basis and also on a quarterly basis. But because the PMI actually tracks GDP very closely, so it's a very, very timely measure of economic activity. If you look at the right-hand side, you can see that there is actually 2 subcomponents of the PMI. So the first subcomponent is actually manufacturing output, which is a darker sort of green line, and the yellow line is the service component. So a 50 mark is sort of the central mark, and if a PMI actually goes below 50, it means that that particular sector is actually in contraction. And here, as you can see, manufacturing sector is already or has already been in contraction for quite some time. And meanwhile, the service activity is actually still above 50, meaning that it's still expanding. So what's happening under the hood was that although manufacturing was probably already in recession, service was actually particularly strong. That drives up the overall kind of GDP growth. And this is a chart that shows you a very, very long-term history of US personal spending on consumption. It goes all the way back to the 80s. And the thing I wanted to show here is that actually, I mean, this growth in consumption is fairly consistent throughout history, and it also follows a kind of average growth of about 3%. However, you do see a big dip towards the right-hand side, or the top right-hand side of the chart. That is because of COVID. When COVID hit, actually most people had to stay at home. Therefore, I mean, they weren't able to go to restaurants or go to travel, and that's why service consumption actually plummeted. However, post reopening, service consumption actually recovered, and now is actually growing at trend. And this is kind of what is supporting the US economy and a lot of the other developed markets economy, in the sense that we're still benefiting from a recovery from COVID. So why did US consumers keep spending, right? I think number one reason is because the labor market actually held up much stronger than anticipated, or than what the manufacturing data would suggest. And here is a chart on the US unemployment rate. As you can see, it kind of fluctuates. The kind of longer term average over a 10-year period is about 6%. So as you can see, also there are some red shaded areas. These are the historical recessions. So whenever there is a spike in unemployment, that tends to coincide with a recession. That happened also in 2020, where we had a very, very short period of recession caused by COVID, in the sense that unemployment actually spiked to about 15%. Since then, of course, it has fallen back. And today, the latest reading on unemployment rate in the US stands at 3.7%, which, as you can see from this chart, is still very, very low from a historical standard. So when people are actually fully employed and have a job and can actually keep their salaries, and with the salaries also growing, they are able to spend on different things, including services and goods. The thing that is keeping the labor market so strong is something that we have pointed out a few months ago. This is a chart that we first show in middle of last year, middle of 2023, which is a study that we did on the U.S. labor force. So the dark blue line is the U.S. labor force, which is the number of people who are actually working in the U.S. As you can see, before COVID, there was 164 million people working. However, that number actually fell quite dramatically. Almost kind of 10 million people sort of disappeared from the workforce. That number actually climbed back up, but actually a lot slower than I guess what the trend line would suggest, which is the dotted kind of gray dash line, as the dotted blue dash line. And if we project it to today, we're still seeing a gap of about 2 million workers in the United States. And the reason why some of these workers are still missing is that, number one, a lot of people took kind of early retirement back during COVID. And for these early retirees, they're unlikely to go back to work. And then secondly, there's a lot of movements in terms of people like across cities and even like just kind of getting used to working from home. So that creates some gap as well. The main crux of this chart is just to show you that the US labor market, and it's actually the same in other developed markets, in the sense that labor market is still quite tight. Therefore, the unemployment rate is still very low, and therefore, the consumers can actually still keep spending. So the other thing that happened in 2023 was a very significant rate hike. And if you look at the current cycle, which is the yellow line in this chart, this chart basically plots out the historical kind of rate hike cycles, starting from month 0, which is when the Fed first hiked interest rates. And it plots out the cumulative change in interest rates since the first hike. So historically, there has only been 3 other times when the Fed hiked more quickly, which was in the 1973, 74, and 1980s. Those were periods when inflation was also double digit, and the Fed actually took interest rates to more than 10%. Since then, we actually have not seen such a fast pace of increase in interest rates before. So why has that not kind of filtered through to the economy? Why has it not caused a recession? When we look at what's actually happening to the US consumer and all corporates, what we realize is that it actually did not impact the consumer that much, and it actually benefited the corporates. So here are a few charts that suggest why the data show those 2 points. This chart shows you the household debt service level, which is basically, for example, if you earn $100, how much of that goes into servicing different types of debts? It can be mortgage, it can be your credit card debt, it can be like your car loans, right? So the white line shows the total debt servicing ratio that is kind of at about 10%. During, I guess, the depth of COVID, when the government actually handed out a lot of stimulus checks, this ratio actually fell to kind of almost 8%. Since then, it's bounced back to 10%, but this 10% is still, I guess, quite consistent with the level that we've seen in the past decade or so. So there's nothing alarming here. Despite the increase in interest rates, people are not spending more money on servicing their debt. Also, the mortgage rates, despite also rising, a lot of people actually have the mortgage rates locked at a very low rate in the past few years. So therefore, even though the Fed was hiking interest rates, the mortgage debt servicing ratio is also quite low at around 4%. And actually, interestingly enough, high interest rates actually benefited U.S. corporates in a sense that it makes them gain more in interest income rather than paying more in interest expense. Again, this is because when U.S. corporates actually raise capital, they tend to raise capital not in a short-term fashion, right? For companies who can raise capital, they would raise capital in 5, 6, 7 years time frame. So a lot of them actually raise capital when interest rates were low. They were able to take advantage of this low interest rates. So when the Fed actually starts to increase the short-term interest rates, these companies actually did not need to pay out more in terms of interest expense. However, on the other hand, because there's a lot of cash sitting on the balance sheet of these corporates, when they put these cash into the bank, they're actually earning a lot higher interest rates and a lot higher interest income in the form of the savings rates. So just as McKinsey said in the beginning, right now, for example, you can earn north of 5% if you put your cash in US dollar cash products. Same for corporates, they're earning a lot higher interest income. Therefore, net, actually, the data shows that US corporates almost saved 90 billion in terms of interest expense in 2023. So that's why when the Fed actually increased interest rates, there was a very limited kind of flow through to both the consumer and the corporates. Now, that kind of concludes the review of 2023. So in retrospect, I think number one, the Fed increased interest rates. However, like the U.S. consumer and the corporates are still strong, which is supporting the U.S. economy. And if we think about the future outlook, one of the key pillars in the StashAway framework is our ERA investment framework. So ERA stands for Economic Regime Asset Allocation Model, for those of you who are new to StashAway. I mean, this is basically how we optimize our portfolios according to the different regimes in the economy. And since December 2022, we were actually in a stagflation regime, meaning that growth is slowing down, but inflation is still high. So typically, a stagflation regime would transition into a recession regime as growth slows down even more and inflation slows down even further. However, I mean, we've seen kind of a longer than expected, or compared to history, a longer phase that we spent in stagflation since December 2022 because of the data that we're seeing. So here is another depiction of how both growth and inflation would change in a cycle. And the green line here is the middle line. So above the green line is expansion and growth, and below the green line is contraction and growth. Same for inflation. If we're above the green line, it's high inflation. Below the green line, that's low inflation. So we're kind of in the middle of a kind of contraction phase for growth, and also in the middle of a inflation kind of coming down, but still high phase. Historically, this phase has been very, very short. So, for example, the last time we had this was in 2007, right before the financial crisis. This time around, however, we're seeing a slower play out of the stagflation regime, and this is depicted in this picture. So, if we go through inflation and growth in kind of two different axes, let's start with inflation. So this chart actually shows you the inflation data for major economies in the developed world. So we have US in white, and then some of the European economies in different colors. So as you can see, inflation is not just a US problem. European countries actually also suffer from inflation. And even though inflation has been coming down, it's still above, way above the 2% that central banks are targeting. So what we think is that when we look at the data, obviously this inflation or slowing down inflation is a welcoming sign. However, if you look kind of underneath what's driving that inflation, you can kind of divide it into supply-driven versus demand-driven drivers. Ideally, you like to see supply-driven drivers coming down, which means that, for example, it's an easing of supply gluts in oil, in commodities, even in the labor market. The supply-driven kind of inflation coming down is much more sustainable and it supports economic growth. However, in this chart, where we divide up the core PCE, the core inflation metric, into supply-driven factors, which is the light blue, versus the demand-driven factors, which is kind of darker blue. What we found out is that the demand-driven drivers have been driving most of the inflation coming down. So what does that mean? It means that supply is still tight for certain commodities and arguably the labor market, which makes it harder for inflation to come down further without a further slowdown in economic growth. So we think actually, I mean, that kind of rolled down to 2% from where inflation is today could be bumpier than what people would expect. So one of the supply side factor is definitely oil. Despite all the talks about technology and kind of renewables, oil actually still matters a lot in the macro kind of outlook. So here is a chart of WTI oil. You can see that it's been kind of it's gone through three very distinctive phases since the 2010s, like in the last 14 years or so. So if we look at the average of oil prices in these three different regimes, we can see that in the early 2010s, oil was actually averaging $92 on average. And that is, it basically took a big step down to $53 from 2015 to 2020, like before COVID. And that was because of the discovery and development of shale gas in the US, meaning that basically you see a big increase in oil supply. After COVID, however, oil prices actually is now averaging $80 on average. So it hasn't gone back to the range that we've experienced before COVID. And that is due to a few factors. Number one is that, I mean, there's concern about the US shale gas kind of being exhausted in terms of development. And then secondly, of course, the OPEC is having production cuts to try to support prices. And then lastly, I think, which is probably the most prominent but unknown kind of factor, is geopolitical risk. As we've seen, I mean, since COVID, we've gone through the Ukraine war. Now there's disputes in the Middle East. So the market is actually giving a certain geopolitical premium to commodity prices, which supports a higher range compared to pre-COVID. So this range is unlikely to come back down unless we have a recession. Also, if you look at the forecasts by the U.S. Energy Information Administration, which puts out these forecasts every month, you can see that in the last 2 years, actually, oil production exceeded oil consumption. And going forward, what they're forecasting is that, on balance, consumption could meet production. So I guess the story here is that there is upside risk to commodity prices going forward, at least in the next few quarters. Here is why oil prices is actually quite important, because here we're trying to plot out two time series. One is the five-year inflation expectation. So this is what the market is telling you in terms of what they think the inflation would be 5 years from now forward. And if you plot this expectation out, compare it with crude oil prices, you can see that there's actually a very, very tight correlation, meaning that so-called market expectation is mostly based on what they see in commodity prices today. And the reason why this is important is because the Fed actually takes into account inflation expectations when they try to set their policies. And so, again, here is the same picture, right? In 2015 to 2020, the average kind of forward expectation of inflation was consistently below 2%. Now is actually consistently quite above 2%. So if oil prices actually stay in a higher range going forward, then this inflation expectation could stay above 2% for quite some time. So I talked a little bit about labor market. Labor market is actually a very, very key, I guess, aspect for us to understand both growth and inflation. Here is a chart that shows the ratio of jobs plentiful versus jobs hard to get. And again, this is the Fed's kind of preferred metrics to see how tight the labor market is. And as of today, the ratio of plentiful versus hard to get is still at a historical high, meaning that basically there's still a lot of people looking for employees rather than employees looking for jobs. So the labor market is cooling a bit, but it's still quite strong. And when we look at the US consumer, we do see some signs of weakness, but nothing really alarming. Here is a chart on the credit card delinquencies in the US. And as you can see here, it's off from the kind of the absolute low levels achieved in 2021 and 2022, and it's been slowly rising to about 1.3%. But still, this is way below where the average was before COVID. So if you read the headlines, you may see, oh, US consumer credit card problems are rising. But if you look at the data, even though is weakening, it's nothing really alarming. Are there pockets of concern? Yes, probably. So one thing I think worth kind of maybe quickly pointing out is that there is a rise in not just using credit cards, but also a program called Buy Now, Pay Later, which is kind of installment programs that allows people to pay for your purchase now, but then have installments to repay later. And typically these come at very, very low rate or zero rate because these are partially financed by the merchant itself. Worth noting is that for Gen Z, who are shopping for the holiday season, 54% of them actually use Buy Now, Pay Later. So this is kind of, I think if you look at where the future spending power will be, a lot of them actually comes from the younger generation, and is just a bit concerning that the Gen Z spenders are actually using much more of this program to fund their online purchases. So I guess in conclusion, what we've seen is that I guess in terms of growth, things are still quite robust. The labor market is still quite strong. Inflation is coming down, not as quickly as the market wants, but still, it's going in the right direction. So the question is then, well, is it all good? Are we going back to the good old days of just, strong growth and smooth sailing? I think we have a slight problem because that's actually what the market is pricing in. And also historically, soft landing has only happened once. So if we look at this chart, this plots out historically the Fed interest rate hike cycles. And we've actually color-coded them. So the red periods were hard landings, meaning that the US actually entered into a severe recession. And the green is soft landing. So basically, the Fed was able to hike interest rates without causing a severe slowdown, and the yellows are somewhere in between. So a real soft landing actually only happened once in 1995, and that was because the Fed actually was basically tightening, but then there was there was turmoil in international markets, which allowed the Fed to actually cut interest rates even before the US data itself showed weakness. But in all the other instances, you either have a hard landing or kind of a not so soft landing. And I mentioned that this outcome is now being quite well priced into market consensus. This is a chart that shows you the market forward thinking on how the Fed would change its interest rates. So if you focus on on the top of this chart, you can see a table. So for each meeting, there is actually a market probability implied rate in terms of cuts, and also the probability of such cuts. So if we just kind of zoom into the December meeting, which is the second last meeting from the bottom, the one that's December 18th, you can see that the market is now pricing in 6.5 times of cuts for the next 12 months or so. And that implies a interest rate reduction of 1.6%, and that implies a rate of 3.7%. And this, I mean, to me, it's a very, very aggressive kind of expectation, particularly if inflation is coming down, but not as quickly as market wish to the 2% threshold. And I guess another reference point is that even at the beginning of 2007, 2008, the financial crisis, I mean, I guess the interest rate market have not priced in such a fast cut before. So what the interest rate market is telling you is that either supply side inflation comes down very, very quickly, which we've shown is still quite sticky, or that we get a recession such that the Fed has to cut very aggressively. And the problem is that this is not priced into equities, right? So equities is telling a different story. And this is a chart that shows you the ISM index or the PMI index, which is in light blue, versus a year-on-year change in the S&P index. So again, there's a tight correlation between the two, meaning that when the PMI actually trends upwards, you get better returns for the S&P and vice versa. Now, if you zoom in on the right-hand side of the chart, you can see that S&P year-on-year return is now coming to positive. It's actually been up 20% year-on-year, and it's made the turn. However, this is not confirmed by data. So in terms of the PMI, is still hovering around below 50. So the data has yet to confirm what the equity market is saying in terms of a sustainable recovery. So going into, I guess the next thing that we looked into is that apart from the US, what do we think about other regions, right? Are there better opportunities out there that we can actually invest in? The first thing that we looked, of course, is other major economies, which includes Europe and China. So here's a chart that shows you the PMI data for Eurozone versus different economies in the Eurozone versus US. We've actually color-coded the PMI so that it's easier to read. So the redder it gets, I mean, the more kind of negative that number is, or the worse it is in terms of economic growth. And the greener you get, I mean, the better. So here, I mean, we see a few things. Number one is that the major European economies all started to turn red in the past few months, starting from the second half of 2023. And actually, the more industrialized or the more industrial-oriented economies had more reds than the more service-oriented ones, which echoes what we see in the US as well. And the US and global ISM, so PMIs, are actually now kind of white, so they're much more neutral. But it certainly seems that the Eurozone is actually entering into a more severe economic downturn than the US. And looking across the continent, we also revisit China. And here, I mean, China obviously had a very, very tough 2023 in the sense that it's suffering from both a structural and a cyclical downturn. And I mean, for us to get more positive in China, ideally, we would like to see kind of the data turning around, because China was actually arguably the first kind of major economy to enter a recession. So we would actually expect it to come out of a recession like sooner. However, the data is actually still showing a very, very subdued economic growth. So on the top here, we can see inflation data for China, both the CPI, which is a consumer price index, and PPI, which is a producer price index, which tracks the commodities in China. And both are actually in deflation territory. So this is actually a different set of problems that China is facing versus the world, and in the sense that they were trying to fight a very, very severe slowdown in economic growth, which resulted in deflation. And in the bottom, we can see the manufacturing PMIs, which are still kind of in negative territory. So we're still waiting for a confirmed upturn in China. which means that among the major economies, actually, I mean, US still stands to be the most resilient, which is why to start the new year, we think that it still makes sense to be more focused in US investments. The other thing that that is kind of hitting the headlines in China, and I think could be one of the things that gets investor concern, is local government debts in China. So here's a chart that I borrowed from Bloomberg, which shows you the maturity of these local government debts in China would exceed kind of would exceed 4 trillion in 2024. So obviously 2023 we saw defaults in the property bonds, and a lot of people were concerned that this would turn into systemic risk, which I mean we did quite a deep dive into, and our analytics shows that the banks are able to kind of absorb a lot of these bad debts. But I mean, this local government debt is another kind of big worry. However, looking at the government's resolute and also ability, we think that the government will be able to kind of stop the defaults, and it seems like the government is determined to backstop any default. And this actually shows in the in market prices. So on this chart, we show you the spread of these local government bonds versus the rating of Chinese government bonds. So the higher the spread, the riskier these bonds are. And as you can see here, the spread is now about 100 basis points, which is at a historical low. So the market is actually telling you that, I mean, the government backstop is actually working, and there's no worry about these bonds defaulting. So I mentioned about the top kind of the major three. Now, what are the other things that we as investors can focus in? And I think this year it makes sense to focus on domestic reform stories, because I mean the global macro is still quite uncertain, but there are a few things that are happening in domestic markets, which is quite structural, which warrants attention from us as investors. Number one is Japan. Now, of course, Japan had a very good year, and also a very good start to the year as well. So we're seeing, I mean, I guess the Nikkei tried to make a go perhaps at 40,000, which was actually what it achieved in the early 1990s. So this is a 30-year of recovery. We think the structural story for Japan is that return on equity should continue to improve. There's actually a lot of room for it to improve. As you can see here in this chart, this shows you the return on equity of Japanese companies versus a lot of the other companies, a lot of the other countries. And the higher your return on equity, the higher your valuation can go. So for example, in terms of price to book ratio, the market would actually reward you with higher prices. So Japan is still ranking very, very low. And we think that given a lot of government incentives, there is room for Japanese corporates to improve their returns. Of course, I mean, when you invest in Japan, you need to pay some attention to the Japanese yen. And last year, the Japanese yen weakening was a significant tailwind. We think that this year it may present actually as a slight headwind. But if that actually starts to happen, we think it would create like a good opportunity for investors to get into Japan if they're not exposed to it already. I won't go into this chart, but basically it has to, I mean, if from a foreign investor's perspective, we need to think about how we hedge the currency. So if Japanese yen actually starts to strengthen, then I mean, basically it could create some short-term fluctuations for Japanese equities. However, the major story in Japan this year is actually probably not foreign flows, but domestic flows. So this year, the Japanese government is changing its retirement schemes to attract more people to invest. So they're basically having tax incentives. And we expect a inflow into Japanese equities as a result of this, which would amount to more than kind of 50, 60 billion. So that's actually quite significant. The other structural story that we like a lot is actually India. So India has actually been a strong performer last year as well. But if you look at the last 20 years, India has actually been a consistently strong performer. Here, MSCI India actually returned 10.5% on an annualized basis, which compares much more favorably compared to global world equity, and also slightly beating S&P as well. The India story, we think, is getting better because of two factors. Number one is that historically, India has been underinvested in the infrastructure. But recently, we've seen a change in that. So, for example, the government spending on infrastructure has almost doubled in the past 3 years. The second problem that India has faced is the high inflation problem, which erodes into the currency, which means that from a foreign investor's perspective, that also erodes into your returns. So here's a chart for India inflation. And before 2015, India inflation actually averaged about 8%. Since then, what has happened is that the Central Bank of India has introduced a target inflation mandate, and it's been actually quite effective, right? Since then, I mean, in India's inflation have come down to 5%. So it doesn't have the inflation problem that the developed markets are actually facing right now. So that kind of concludes like some of the thoughts that we have on the US and also regional themes. Perhaps I'll just spend a quick few minutes on how do you position your portfolio. So there are, as McKinsey mentioned at the beginning, we try our best to like think about what could happen and think about the different scenarios. This is a chart that I borrowed from JP Morgan. Of course, they have a lot of people crunching numbers and looking at like different scenarios. But if you look at all these scenarios, it's I think a lot of us would just kind of not be able to digest and also think, oh, like all these things are happening, these different probabilities, how am I going to invest? So there's a few things that you can do. Number one is that ERA at StashAway actually helps to manage your portfolio according to these shifts in macro winds. So using our systems and data, we actually monitor like all these changes on a real-time basis, and also we create kind of diversified portfolios that can weather through different scenarios. So, for example, a diversified portfolio in our case have a portion to global equities, to cash, to aggregate bonds, et cetera, et cetera. And these allocations actually change according to what is the attractiveness of certain assets under that particular economic regime. For example, today, I mean, cash is still very, very attractive in terms of generating very, very safe yield. That's why we have more allocations to cash across our portfolios. Secondly, I think amid all the uncertainties, you can be sure of one thing, if that's the only thing that you take away from this webinar, is that eventually markets recover, and over the long term, markets always go up. I'm talking about markets and asset classes, not talking about individual securities, because that is a different, individual securities actually could actually go to zero. This is a chart that shows you, say, 60-40 portfolio, which is a 60% equity, 40% bond portfolio since the 1990s. And again, the red periods are the recession periods. So, yeah, when you go through a recession, there could be some correction. However, these markets eventually do recover, which is also why in the title we say it's a matter of when, not if, because this is one thing for sure. If you stay invested, you reap the benefit of long-term investing over the long term. And also, I mean, some of these long-term returns are actually based on pretty solid fundamentals, right? So, for example, when we look at the S&P, long-term total return is 10%. So this actually comes from what, 5%, 6% of profits growth every year, 2 to 3% of buybacks, and also 2% of dividends. So all these are very predictable and reasonable, fundamentally driven returns that do not fluctuate according to like the mood of the moment. Of course, in the short term, things can fluctuate, but over the long term, fundamentals actually provide the reasonable returns. Same thing for interest rates. So, for example, if we look at a long-term valuation model, which is what we've put in here, fair value interest rates is probably around 3 to 4%. This comes from a long-term inflation of 2%, real interest rate of 0%, and also a certain term premium. So you can actually break down these returns into fundamental blocks and try to understand why and where you're getting your returns from. And then the next thing that you do is to overlay the risk and the volatility of these asset classes and how you can, and the level of volatility that you can withstand to come up with a reasonable portfolio. So I guess in the interest of time, I won't go through these slides, but basically, for example, US equities actually grew 81 times since 1985, actually since 2011, and this is just from compounding at 11.5% per year. So even though on a yearly basis, it's, I mean, 11.5% is just, I mean, a kind of, I guess, a moderate return. If you compound through the years, it can generate very significant returns. So I'll just wrap up with these few key takeaways for tonight. So for example, like I guess number one, StashAway's general investing portfolio posted solid positive returns in 2023, on average 11.8%. Our era investment framework is still like flagging in a stagflationary economic regime. However, we do expect things to move as we move along in the inflation and growth curves. The market is now looking for a soft landing in the US. However, we note that number one, the outcome has been quite rare historically. Number two, it also appears to be well priced in by markets. So the risk reward of that scenario may not be that great. Fourthly, the US is still best positioned among the big three. We still see challenges in Europe and China. So still, I mean, to start the year, we can focus on US equities. Fifth point is that there are interesting domestic stories that we can kind of pay more attention to. For example, Japan and India has kind of multi-decade structural growth and reform stories. And then lastly, when investing, what's most important to remember is that it's timing the market, not timing the market, as we've shown in various charts. So with that, maybe I'll take a pause here, and I'm sure we have a lot of questions. So why don't we start with those questions?
Yeah, so thank you, Stephanie. And I had promised to some of our colleagues that we were going to be done by 8 Singapore time. Maybe we're going to just go a few minutes later than that to make sure we accommodate some of the questions. Now, a lot of the questions actually address topics that you have somewhat touched upon, so we don't need to kind of go much deeper than we went, but I may ask some of these nevertheless just for you to maybe clarify some points or repeat some of the things that you said. Maybe I'll start from kind of a macro questions and then go into more details. So Angred is asking, there is much talk in the US about a soft or even a no landing. What is the prospect for the rest of the world in achieving a soft landing? And what would this mean in terms of asset allocation? You talked a little bit about Europe, China, Japan, India. What does that mean in terms of asset allocation if you make a step back?
Yeah, I think it's a great question because I mean we're starting the year, and if you kind of rewind 12 months backwards, people were looking for a recession. Of course, that never happened, and now we're looking for a soft landing. And I think if you compare different regions, the different regions actually go through different economic cycles. So, for example, China was already in a recession for quite some time. So, in terms of China, there's no question of soft landing. It's I mean, basically, it was a hard landing. And the question is like when China is going to emerge from this hard landing. And so far, we have not seen like very forceful stimulus. And secondly, I think there's like still some confidence issues from the demand side. So, for example, you would need people to start to invest. You would need people to start to spend, and I think that takes some time still. In terms of Europe, if the US can achieve soft landing, then I mean Europe may be in a better shape. However, the data that we're seeing is that Europe is actually going into a recession sooner than the US already. I mean, if you recall the slides that we've shown a few kind of here in terms of what's happening in Europe, the data is already in like the leading indicators are already in red, showing that the activity is actually in contraction already. So I think the chance of a soft landing in Europe is even more distant than US. Not to mention that it's also much more sensitive to oil prices. So if there's any kind of oil price spike due to geopolitical reasons, and I mean Europe is actually much more vulnerable.
Kind of a couple of follow-ups to this, and then maybe I'll move to more specific topics. So the first one is, what can go wrong from a US economy? So what can make the US economy fall into hard landing instead of soft landing? And from an investor perspective, if we know the economy is slowing down, why should we invest now and not later? So can I time the market?
So let me just go back to the ERA frameworks. So we look at this chart. Going from stagflation, you can historically either go into recession, which means that like things actually get worse, or you can go back to inflationary growth, which is not like a typical case, but there were cases when it happened. So I think the risk is not that we go into a recession or inflationary growth, because in a recession, it may sound like very difficult, very harsh, but actually it's not. As an investor, you actually benefit from inflation, from the sense that if you have a balanced portfolio, bonds would actually provide some protection and some cushion versus your losses at equity. So in a recession, actually portfolios perform relatively decently. If we go back to inflationary growth, that means that equities and the commodities would actually outperform. So from an investor's perspective, it's also not that bad. I think the risk is that we stay in stagflation for another like 6 months or 12 months, because in a stagflation, asset classes tend to correlate to one, meaning that bonds and equity actually move together. And that is what we've seen so far, and it's still happening, right? Even in the most recent sessions, year to date, for example, when bonds actually fell, equities fell as well. So from an investor's point of view, it's actually much harder to create diversified portfolios out of a stagflation regime because of this high correlation. That's why I think the risk is that we stay in stagflation for much longer. And I think the second risk is that, of course, I guess the Fed, given that it's increased interest rates so quickly, some of the effects start to filter through. But which causes kind of economic slowdown gradually, but also inflation kind of staying higher. In terms of how we construct portfolios in these different regimes, as I mentioned, in a recession, having a diversified set of bonds and equities and gold would actually help you to position for that. If we stay in stagflation as we are right now, having a healthy kind of overweight to cash actually helps to protect your portfolio, which is how we position as well, right? Because cash is now generating very, very decent yield of north of 5% in US dollar, and with very, very minimal volatility. So in a stagflation, cash is still kind of the overweight, and that's why ERA portfolios are actually all overweight cash.
And the follow-up to that question was, given all of these potential risks, why should I not wait? Why should I invest now?
Yeah, I think so. Again, going back to our kind of our long-term positioning charts, right? I think number one, you can see that, I mean, there would be dips throughout the investing journey. However, I mean, we try our best to predict, but none of us have a crystal ball. So if things actually turn out to be a soft landing, which obviously is a very kind of hard thing to do, but it could be one of the paths that we face, then I mean, you don't get the correction that you've been waiting for. And also having a diversified portfolio helps you to weather through some of these drawdowns. And that is exactly how StashAway portfolios are designed, right? So if you are kind of more risk averse, then you can pick a portfolio that is, for example, SRI 10 or 12, that gives you limited drawdowns, even if the worst case scenario actually happens. And then secondly, I think also if we look at some of the pockets like Japan, India, these are more domestic stories that are, I guess, less correlated with global kind of macro winds that you can also invest in. So even though, I mean, the macro, if you're uncertain about macro, even if we go into recession, there are like pretty good opportunities out there that we should actually make use of.
Thank you. There is a couple of questions on sectorial trends. You talk about some countries. You talk about Japan and India, for instance. There is a couple of people that ask, what are the sectorial trends you see going into 2024? Is it healthcare? Is it AI again? What about energy or cyber real estate? Do you have any perspective on this?
Yeah, so I think if you look at how the sectors have performed in 2023, obviously tech was a big winner. So if you take out technology stocks, the S&P returns will be a lot more subdued. And that was mostly driven by AI. We think that AI is definitely a structural trend or a structural kind of factor that will improve corporate profits and also productivity. So it's something that we should definitely pay attention to. However, in the short term, it's also like fairly overly hyped. So a good analogy to that would be kind of the tech bubble in the 2000s. So a lot of money has been going into that sector. However, after the bubble burst, there's actually some great companies coming out from that kind of segment. So we think, I mean, right now, of course, there's a lot of money going to AI as well, and its valuations are definitely higher. So if there are other opportunities that are better, then it makes sense to kind of diversify your bets, right? Not just having everything in the Magnificent Seven, for example. And I think healthcare is actually one of the better alternatives for this year for several reasons. Number one is that healthcare is actually a much more defensive sector, so you get the defensiveness of that cash flow, because most of these companies, if you think about it, even if you go through a recession, you still need to like kind of consume these medicines or go to see a doctor. So that cash flow is actually quite stable. The companies are actually quite cash rich. And then also healthcare has a component of growth as well. So for example, like companies keep innovating on medicine and also kind of better treatments. So there is growth in the industry. And then lastly, I would say that because in 2023, it actually underperformed the other sectors. So I mean, now is not a bad time to kind of start to look at healthcare as a sector. I think in terms of other more cyclical sectors, if we're seeing a US kind of slowdown in the economy, then these cyclical sectors may not perform that well. Cyclical sectors typically are associated with like industrials, like financials, et cetera, et cetera. So like from a cyclical perspective, I think I mean, those sectors may actually underperform the index. So those are areas that we'd probably stay away from. Michele, you're muted.
Sorry, I was muted. Yes, I was speaking to myself. I was very quickly, quick follow-up on this. A client is asking, are the Magnificent Seven overvalued? The Magnificent Sevens are for obviously the kind of the 7 big tech companies that have dominated the market in 2023. Are they overvalued?
So if you look at things from a PE basis, they're definitely not cheap, and have recovered faster than the market did. However, that is also partly supported by earnings growth. So for example, if you look at the earnings growth for the Magnificent Seven versus the S&P, the S&P as a whole actually did not grow its earnings, but the Magnificent Seven actually had kind of double digits earnings growth. So part of that rally was justified by this improvement in profits. However, I think there has also been a significant outperformance of these 7 companies versus the rest. So for example, even within the technology sector, there are companies that are kind of much more underperforming in the past 12 to 18 months. So perhaps, I mean, this is a year that you should actually expand the horizon and to think about kind of the broader market. Now, having said that, I mean, we've always invested in ETFs, right? And one of the reasons why we prefer ETFs to selecting single stocks is that it's very, very hard to predict what a stock would do, given that there's so many factors affecting a stock, right? Be it like what the CEO says, or like the latest earnings script, or like an analyst upgrade. But an ETF on the market actually gives you, number one, a broader exposure to different companies and sectors. Number two, it actually automatically rebalances the portfolio so that the better companies actually get like higher weights, and the worst companies actually get lower weights over time. So over time, the reason why it's so hard to beat a benchmark is that the benchmark or the ETF automatically rebalances towards the companies that are better. So I think if you think about how do you get exposure to different markets, I think, I mean, ETFs actually give you a very, very good way and very, very cost-effective way to just get invested.
Thanks, Stephanie. We are already 7 minutes after what I wanted as our deadline. Let me ask you 2 more quick questions, and apologies for, I have actually more than 20 more questions. Apologies to the ones to the people that have asked some of the questions I'm not addressing. A lot of them were actually addressed during the presentation, so hopefully you got your answers anyway. So two more questions. The first one is, will bond funds outperform this year given the rate cuts? And then I'll give you the second one in a second.
Yeah, I mean, I guess you can define outperformance in different ways. So let's just kind of, maybe I'll take the question as will bond funds actually have positive returns this year given the rate cuts? Because I guess, I mean, still these bond funds are in the red from the 2021 heights. So I mean, if the Fed do start to aggressively cut interest rates, I mean, the way that bond math works is that bond prices would actually start to recover. And I skipped one chart here, which I mean, maybe now is a good time to show. Actually, sorry. Because I mean, this actually shows you the long-term, a long-term perspective on bond yields. And as we all know, like when yields actually fall, bond prices increase. And that's what happened since the 80s up till COVID. So since 1980 to 2020, which is a 40-year period, actually interest rates were just on a clear downtrend. And to the point that, I mean, long-term interest rates were falling to 1%. So there's no room for it to fall anymore. And then we had the Great Reset during COVID, in the sense that, I mean, the Fed actually increased interest rates dramatically. What this means is that if we kind of follow the pattern that we've seen in the past 40 years, the Fed's aggressive interest rates have actually just created another decade of runway for bonds. And this is significant for us as long-term investors because I mean, there is a lot of questions, I guess, on I mean, where are you going to get the returns from bonds if yields are quite low? Now today, I mean, yields are not low, right? It's actually back to a level where you can see pretty decent long-term returns. So I think from that perspective, yes, if the Fed starts to cut interest rates, or at least not start to hike rates, then bond markets should start to recover.
Last question, because it's the topic of the last few days, and I guess there was 2 questions about it. Last week, Bitcoin ETFs were approved. Any thoughts on that?
Yeah, so I guess, yeah, a few thoughts. Number one is that it's definitely a big step towards making Bitcoin or cryptocurrencies as a whole a more investable asset class for institutional investors and also retail investors. Because I think if you look because I guess if you look across the universe or different exchanges, right now, most of the crypto ETFs are futures-based. And futures-based products is actually not a very optimal product in the sense that it costs a lot to roll. And that's why when we actually launched our crypto add-on for Singapore accredited investors, we went to a Canadian exchange where we could find like physically backed Bitcoin ETFs. So it's definitely great news that the US is approving Bitcoin ETF. And also, if you look at the caliber of the issuers, they are the world's biggest fund managers, right? You have BlackRock, you have Fidelity, you have ARK starting these ETFs. I think as with any other ETFs on our platform, we evaluate ETFs on several criteria, and we actually put them through a scorecard to rank them. So in terms of Bitcoin ETFs, we also do the same ranking. And I guess just a sneak preview will be kind of doing perhaps a reshuffling or replacement of our current ETF as well, given that there is alternative now in the US. But mostly speaking, I mean, the criteria that we use to evaluate these ETFs is number one, of course, the cost of owning these ETFs, which includes the management fee and also the bid ask and also kind of trading fees. Secondly is the kind of the track record of the ETF. Now, of course, here you have very, very new ETFs, so the track record of the issuer is very important. And particularly in terms of Bitcoin, the custodian structure is also very, very important. And thirdly is basically liquidity of the ETFs. Already in the first few days, we've seen that most of the liquidity actually goes to just a few issuers. So like focus on those with volume, because that's how, I mean, you can ensure that you can, I guess, get in and out in a fairly quick manner. And then lastly, of course, when we consider ETFs, we also consider like the tax implications. Now, this is very specific to each individual investor, so I won't go into it here, but that is also one consideration.
Thank you, Stephanie. And I know I've went way above limit. Thank you so much. Apologies for the people I could not address the question of. We addressed most of them through the presentation. If you still have a question that you want an answer to, please write to us at support@stashaway.com, and someone from our team will respond. And obviously, if required, we'll check with Stephanie or myself or the most relevant person. Support@stashaway.com will actually get you a specific answer if you have any questions there. Otherwise, thank you so much for joining tonight. I hope this was informative. It was definitely interesting, at least from my perspective. We talk about these topics often with Stephanie, but it's always good to kind of see it in a presentation and see everything together. I hope this was interesting for you as well. And again, thanks a lot and have a good night, everyone. Thank you, Stephanie. And thanks to also Joseph and Priya, who were kind of in the back end helping out and answering some of the questions in writing.
Thanks, McKelly, and thank you everyone for dialing in. Have a great night, and we'll speak to you soon.
Thanks a lot. Bye-bye.
Thank you.